Thank you so much for taking time to join us for this webinar. If you've tuned in today, it's likely that you're renting and you've got a whole lot of questions around how this 0% deposit shared equity product works. We're really excited to take you through some of the features of the model, but also to look at a lot of questions that we hear from customers like you who are looking at this product. So thanks for joining us.
I appreciate having us here today. Thank you.
Before we get going, we wanted to offer an acknowledgement of country, understanding that you're probably tuning in from many different countries and lands right across the country, and want to pay our respects to elders past and present and recognise that enduring connection of Aboriginal and Torres Strait Islanders have to country, particularly as we're talking about housing. So just to introduce ourselves on the call today, my name's Lucinda. I'm one of the co-founders of Zeroo Home Loans. I've got a background in property and housing and really excited to chat to you today. Also joining me is Nia Davidson.
Thanks for having us here today. Excited to be here. My name is Nia. I'm the CEO of Zeroo. Excited to chat to you today about our product and how we're helping many Australians. So thanks.
So you might be feeling stuck because you're renting, and that could be one of the core reasons why you've tuned in today. And if that's you, you're not alone. It's a really challenging housing market in Australia, and I think this graph shows it better than anything else. If you look at the difference between housing prices and wages in 1985, the average house price was about 3 times the median wage, the median house price. In 2025, the median house price is about 10 times the median wage. So it's really got nothing to do with how much avocado and toast you're eating and whether or not you're buying products of Temu. The housing market is objectively much more unaffordable and much more difficult than it was a generation ago. We've seen house prices grow at 70% with wages only increasing around 30%. The sum outcome of that is that the average home deposit is around $200,000. The average home deposit is now about $200,000, which is a huge amount to try and think about saving. So if you're feeling stuck and frustrated, we hear you, and that's why we're here. Just to put this in context, Australia now has the least affordable housing market in the world. So you're not making it up if you're feeling like it's challenging. Sydney is the second least affordable city in the world after Hong Kong. So we're talking about some pretty major challenges when it comes to getting into the housing market. But we still believe it's possible, and we still believe that there is a huge benefit in having a pathway to home ownership and stability and the financial security that that brings. So just a reflection question. We don't actually have a poll today, but just a reflection to think about when it comes to your own experience of what's brought you here today is what do you feel are the biggest barriers to home ownership for you? It'll be different for everyone, and there's likely a whole host of reasons. It's a complicated market, but just have a think about what's brought you here and what are some of the biggest barriers for home ownership for you. Now, we've asked this question to a whole lot of our customers, and we've found that there's one that stands out the most, and that's the deposit gap. Nia, tell us what we've heard from customers and also what the research says around the deposit gap.
That is the biggest hurdle for why people can't get onto the property ladder, why they can't purchase unless they have the bank of mum and dad. Where are they coming up with, the 20% deposit? Even if you're taking a higher LVR product, you still need 5-10% deposit. People are not able to save. It became too expensive to live in our country. Fuel's gone up, rent's gone up, property's gone up, everything has gone up. Wages have not increased, in the same ratio. And it's become so hard. We know now it's taken the average Australian 11 years to save for a deposit. What about, everyone else? It's taken just that long. Like if you lived in Sydney, it's taken 16 years. It's too long to save for a deposit. We hear it time and time again. And this is where we've got a solution to solve the deposit gap, to solve the big barrier of how am I going to get that deposit together?
So you might be earning a good income, you've got a good credit history, you're doing all the right things, but still property prices are growing. So if you're in that situation, here's some ways we can help. If you wanted just to break down how this 0% deposit shared equity home loan model works, can you talk us through this diagram?
Yeah, Really simple. On the left-hand side, you've got the traditional route. You've gone to your bank, you need a 20% deposit. That's 650,000, you're talking $130,000 deposit. On the right-hand side, you've got the same property, but with 0% deposit. So Mondus is basically providing 100% of the purchase price. You don't need to save 11 years. The only thing that we ask for is a 2.2% customer contribution. Now that goes towards all of the settlement costs that are involved in getting the purchase happening. We'll cover that in more details, but you can see the big difference. One, 140,000 you need to save. How long is that going to take? The other, $0 that's needed. There's a very, very big difference. And it means that people can get into a property price today rather than 12 years time when that property is doubled, if not more.
Yeah, that's the challenge, isn't it? That while you're busy saving and being really diligent, the market's just growing at twice the rate of wages. So it's really hard to get in. In our particular model, there's a couple of particular things that really make this accessible. What we've really tried to do with Zeroo is to remove not only the deposit barrier, but to make sure that it's accessible. Nia, can you talk us through some of the way that we think about this? Why is it shared equity?
So really simple. The shared equity, the way that I want people to think about it is you're using the growth of the property, the equity, as your new deposit. So we're waiting for enough growth to happen that you don't need us anymore. We get you in straight away. You get in with no deposit. So we're covering 100% of the purchase price in one loan, super competitive interest rate. So we by far the most competitive interest rate for 100% lender. We look for properties that are going to go up in value. There's no use going into a unit in Melbourne or a unit in Sydney where that property is not going to go up enough in value, because if we've done that, you're not going to create the deposit. So you have a team behind you that sits there and analyzes where growth is happening. We've created one of the most incredible AI tools in the country that shows where growth is occurring, and we can predict and help our customers to go, okay, we can see growth in Brisbane, we can see growth in Adelaide, in Gold Coast, we can see it in Perth right now, we can see down to a suburb level, street level. We're helping people pick the right property with minimal cost, 2.2% customer contribution that covers your building pest inspections, all your legal loan documentations, your conveyancer, basically council rates, everything that's got to do up to the point of settlement that a lot of people don't talk about. We want you to be aware of those costs, and that's where those fees are. But it's getting into a property today with 2.2% customer contribution. That's much better than trying to save for 20% and everything else it's going to take to get there.
And I think it's important to note with that 2.2% that that's not a 2.2% deposit plus all the costs, because you might see other 2.2% deposit products on the market, and that's a really small deposit, but you'll still have all of those other fees like conveyancing and building inspections and legal fees. So that's really what the contribution is for, is those hidden costs that people don't really talk about in buying a property. Let's look at a model of how it actually works, because I think it's easier to, if you see it year by year, what we expect to happen to the property, why we're so selective on choosing the right ones, and how that shared equity growth model really works. Over to you, Nia.
So this example is one of our clients. We use that because we knew it and we know how they've exited. We can see the position. The property value is 650 when they start. Now we're looking for growth in that property value. We wanted the property to get to, circa $1 million. At 977,000, there is 327,000 in growth. Whether you're looking at that now and go, okay, man, that property is now worth 977, 327 sitting there. We are able to help you with a refinance, or alternatively, you can go to another lender. Whoever's the most competitive out there will do the refinance. We take 10% of the property value. We're able to take $130,000 out of the equation. You've got a $977,000 property, but more important, you've got $234,000 that you've able to save during those 5 years. Ask yourself the question, how long will it take me to save 234,000, and how much did you spend in rent over that 5 year? And that's what it makes this product so good and so simple, because it's clear. You can see it as long as there's growth, and that's why you've got a property team that sits behind you to back the right property. There's enough growth. We do a refinance, 10% is ours. We're out of the equation. We're able to go and help another Australian family that's looking to get on the ladder. And we've done our job. We've helped you. You're $234,000 better off.
Yeah, I think it's really interesting to think about it when you think about if you wanted to buy a $650,000 property. And I know that a lot of properties are more expensive than that, but there are good ones in this range that we've helped our customers with. But with a $650,000 property, 20% deposit's $140,000. So, you could be spending 10 years trying to save that. And here in 5 years, you've just built $230,000 in equity in your property. And that's assuming an 8.5% growth rate. We'll take a look at property growth rates in a moment. That's just above the average for capital cities. So the long-term average in Australia is 5 to 6% growth compounding. But we're seeing growth, in double digits, in 10%, 20% in a lot of capital cities right now. So 8.5% is actually pretty conservative estimate. We'd love to walk you through an example of a recent family that we helped, Paul and Bernadette and their 2 kids in Perth, who were buying in this price bracket. And it's a really great story of how they were effectively able to swap out rent for owning. Nia, do you want to give us the background?
Yeah. So current situation, spending a fortune, $850 per week in rent, wasted money. There's $40,000 a year that's down the drain. Put it over 5 years, that would have been $200,000 that they've wasted. Trying to save for the deposit, at least 10 years to come up with $140,000 plus the stamp duty. Comes in Mondes. Look at the solution. For a difference of $162 more per week, we're able to get them in, able to purchase that property. They're now paying off $1,149 per week, $162 more. But guess what? They're not wasting that $978 per week in rent, a difference of $162. And we know the property's grown in value. This particular model, this property went up over 20% in the first year. So the idea of getting to a 5 year, they're not even going to need to do 5 years. They're going to be able to exit even earlier. It just shows that with the right property and the right growth, you can create enough equity for your deposit using the Zeroo model straight away. And it's just so powerful.
We've had some really built a great relationship with this family. And this is one of the quotes from one of our recent interactions with them, because they'd really completely given up on the idea of owning a home. They're a couple in their 40s. They've got 2 young kids, doing all the right things, earning good jobs, earning good money. But without the bank of mum and dad, just really couldn't get ahead of the amount that they were able to save on top of rent. So they'd given up on short-term, long-term, any-term buying a house, and now they're really starting to invest in their future. So one of the things that comes up in this conversation a lot, and we wanted to walk you through today, is where should I buy? So a lot of what we've talked about is building capital growth in the property, using that as your deposit. But how can you know that that's going to be true? Well, Zeroo is really here to help you de-risk that question by using a whole lot of technology, AI, and property data to help you. So we've taken data from all of the 15,000 and more suburbs across Australia and looked at their growth metrics, but not just historically. We're also looking into the factors that are likely to drive growth in the future. Where are people moving to? Where are the amenities being built? Where's the infrastructure investment? That helps us have a compass. It's not a crystal ball, but it gives us a really good way of understanding where those high growth suburbs will be. And we make this available to all of our customers so that they're able to search the suburbs that matter to them. So, if you qualify for Zeroo and we're working with you on a loan, we can give you access to this tool so that you can search the suburbs that are right for you, because the suburbs that are right for you will be different from the ones that are right for me. But we've got a whole range of high growth suburbs to look at. We look at 80 different indicators. We look at that future growth methods, and we've tried to build it in a way that's really easy to use. It doesn't feel like navigating a data platform. It's just helping you have some guardrails on so that you know that you're making good decisions about where to buy. We've also tested this model, and I think this is where it gets really exciting, is that we've now got, many years of data in this platform looking at the growth. And if we've looked at the customers that we've helped just in the last 8 months, we've seen 20.5% growth across our portfolio. So that's well above the 8.5% that we're looking for. And it means that we'll be able to do the shared equity refinance, as Mia said, within 2 or 3 years rather than 4 or 5 years.
I love
So we're
this.
really, yeah.
Shows that it's working. To have 20% growth, it means that the customers are exiting within that 2 to 3 years, not 5 years. It's so, so powerful. But more important, it also shows the market that we're in right now. Get in now before the prices are going to be astronomical. That's the difference.
Absolutely. So let's go. If this is for you, we just wanted to talk about what happens next. So, you're looking for a property, you're excited about the potential of the 0% deposit shared equity home loan model. There's a couple of easy steps. If you've ever tried to apply for a mortgage before, and maybe if you're in this space, you've been working with brokers and other things, it can be a really difficult process. There's a lot of documents, a lot of forms. We've really tried to make this as simple as we can for you, using digital tools and a one-stop shop form that helps you just to upload everything in one place. We can't get around the documents that we have to ask you for in terms of getting the loan origination and banking approval, but we can make that process easy. So the next thing to do, if this is of interest to you today, is to jump on our website. You've probably been there already. Fill in the expression of interest form. That's the first step, so that we can get some high-level qualification criteria and see whether this is the right model for you. You can then book a call with our team where we'll be able to discuss the model in depth for your situation. You can ask any questions. Then we'll send you an application form so that you can do all of the boring but important work in putting the documentation together about your income and expenses. We can then get a conditional approval from our partner bank. Now, once we're at that point, you're able to go and look for properties. We'll be working with our data tool to help you pick the right suburbs, review properties. Our buyer's agent will help you get market opportunities and other niche opportunities in the market, and settle and move in. And we know we've had customers move through this incredibly quickly, Nia. What's the fastest we've had a customer move through these steps?
We probably don't want to use that as an example, but we've gone consultation to settlement in 14 days. Now, that is a record. Don't think that we're going to do that in one. I'd probably say that it's a 60-day process, roughly 2 weeks for us to get a conditional approval. And then, usually it takes a couple of weeks at best case scenario to find something, and then a 30-day settlement. So that, 60 to 90-day period's kind of where it's at for us at the moment with our customers.
But thinking that you might think that you'll never buy a home, that you might actually be a homeowner within 2 to 3 months is a pretty appealing. It's a pretty short time frame.
Absolutely.
So we've got a lot of different questions that have come up with customers that we've worked with and that we've heard through previous webinars that we've done that you've asked us. And we wanted to just run through a couple of those common ones. If you've been listening to this just and got some burning questions in your mind, just bear with us while we touch on some of those quick highlights. I'm going to ask you these questions, Nia. I think let's look at this as a quick fire round. Can I still choose my own property?
Absolutely. We're there to support you, to tell you if it's the right property or not. So choose it. You need to love it. We want you to choose it, but then use us as sounding board to tell you whether it's a good property or not, and we'll provide you with data as to why that is.
Amazing. And do I own my property outright?
Definitely. You're on title. We're not. That's a very, very big difference to us than to other, whether it's the government-backed scheme or other organization. We're not on title. So it's your property. You want to paint the house, you want to do something, just consult with us to make sure it's done by a professional builder and it's certified, but it's yours. We're not on title. We're on loan. We've got a second and a first ranking mortgage, but we are not on title. It's your property. And that's really, really important to know.
And this is a really common one. What if the property doesn't increase in value? I know that we look around and we see a lot of growth stories, but what if it doesn't?
Yeah. So we get this question every day. We're there for the good times and the bad times. If it takes a little bit longer and we need to extend it by another 5 years, so be it. We'll extend it. We can extend it further. At the same time, if you've had huge increase and you want to get out early, we can. If you want to get out early and take a high LVR product and let us exit out early, we can. There is flexibility for both early exit, the entire 5-year term, or further extension. We've got lots and lots of options. It's really important for us that the customer is in a position that suits them best at any given point along the journey.
Yeah, awesome. We absolutely do our best to help you pick a winner, but we can't predict all factors. And so we're really flexible on the way these loans work. And what does the 2.2 customer contribution cover? You touched on it before, but let's just dive into that in a little bit more detail.
There's a lot of cost that comes up for settlement that people don't think about. We want to be transparent. We want to let you know. So first thing you're going to need to do, you're going to need a building and pest inspection. Then we're going to need to consult with a conveyancer for you that will do the title search, registration, do all the settlement part, all the conveyancing fees, all the legal cost fees and documentation to get us there. Basically all your closing fees and some as well as a part of our 2.2% customer contribution fee. You get our property team, you get our team, whether it's our real estate agent, our buyer's agent, your BDM that works with you throughout the whole process. Everyone is there to make sure that it's the right property for you. You get a lot of value for money for the 2.2% customer contribution, but it covers mainly all of your settlement fees.
Yeah, all the things you'd have to pay for anyway. So can I still apply for the first home owner grant schemes? We work with a lot of first homeowners.
Absolutely. We work with both, first homeowners, investors, people that have already owned but don't own at the moment. But if you can qualify, absolutely, because it's going to help you save money. So we encourage you to do that.
Now, this is a tricky one. How do I refinance? So the property's achieved the growth that we expect to in 5 years, 8 years, 3 years, whatever it is. What's next?
Really simple. We keep a track on this for you. We'll probably come to you first before you even know about it. But as soon as there's enough growth, 650, guess what? 5 years later or sooner, the property is 977. We go, hey, time to refinance. You don't need us anymore. There's enough equity in it. We take 10%. We're out the door. You've got so much in there, more than your own deposit and some. You don't need us anymore. So as soon as there's enough growth that you've got your new deposit and we're able to exit, we're out.
Love it. Now, just finally, Zeroo is not for everyone. So just help us understand some of the high level eligibility criteria that we work for to know if Zeroo is right.
As a 100% lender, we have a very tight credit criteria. We have to do that because we want to make sure that we're able to do this again and again and again to the right customers. So income needs to be above 130 individually, or joint income of 130 for the family credit score. 650 if you're applying by yourself, which is a comprehensive score, or 750. Let us check your credit score for you because we can do what's called a soft credit check that doesn't impact your credit score. It's really important that your credit score is clean. We don't want people to impact it. We can look at that as a lender through Equifax, check that the credit score is okay. Age under 55, level of debt. We can't take on a lot of debt because the more debt you have, you don't have the right borrowing capacity. So that is kind of looked at on a case by case basis. But basically, if you think of, one or two small personal debt, whether it's a car lease or a credit card, that's roughly where the credit debt per person sits.
Yeah, that's right. And if you are listening to this and you've got a whole lot of other different personal loans and debts, something that we can still talk through with you around how you might consolidate that and also look at when the time is right for you to lend with Zeroo. That's all from us today, we're here to help. So if we didn't answer your questions today and you've got more, please do reach out to our team, fill in an expression of interest online. We'd love to hear more about you and your home ownership journey. We know it's tough out there. We're here to help.
Absolutely. Thanks for having us. We did a lot of talking. Hopefully, you got a lot out of it, and it's up to you now. So reach out to us. Let us help.